Imagine a company reporting like a staggering 54% surge in profits. I mean, they are throwing off a massive 7% dividend yield, and they just authorized this $1 billion stock buyback program. In any normal universe, you would absolutely expect that stock price to be touching the moon.
Oh, without a doubt.
Right. But instead, it is sinking like a stone. So, welcome to the Byte-Size Brief. Today, we are putting OneMain Holdings, Inc., that's OMF, completely under the microscope. Let's get right into it.
The contrast here is genuinely jarring, because to really understand the stakes, we have to look at who OneMain Holdings, Inc., or OMF, actually serves on a daily basis.
Okay, set the scene for us.
Well, they are the largest non-prime consumer lender in the United States. We are talking about a demographic of roughly, 100 million American adults who simply cannot walk into a traditional big box bank and get a personal loan.
Because they just don't have the credit scores.
Exactly. They don't have the pristine credit scores those traditional banks demand.
Which really sets up the ultimate paradox for any retail investor looking at this stock today. Because on one hand, OMF is basically printing money, right? They are crushing expectations.
They absolutely are.
But simultaneously, their stock just tanked. So we are going to spend this deep dive unpacking this exact tension. Is OneMain Holdings, Inc., OMF, a brilliant, misunderstood value trap? Or is it like a ticking time bomb dressed up as a high-yield opportunity?
I think the sheer scale of the financial success they just reported is probably the best place to start. If you just looked at the balance sheet in a vacuum, you would think this company was bulletproof. Let's look at their full year 2025 results.
Lay the numbers on me.
So net income surged 54% to $783 million.
Oh, 54% growth for a legacy financial company. That's tech stock growth.
It really is. And their fourth quarter earnings per share hit $1.72. That is a 64% jump from the prior year.
That's massive. And the board of directors is clearly feeding off that momentum, right? Because they just raised the quarterly dividend to $1.65 per share.
Right, which works out to $4.20 annualized.
Yeah. And on top of that, they authorized that new billion-dollar share buyback program. They already bought back, I think, about 1.2 million shares just in the fourth quarter alone.
Yeah, they did. And, it is not just their legacy personal loans driving this engine either. They have been really aggressively expanding into new products. Their auto finance business reached $2.8 billion.
Wow.
And their credit card business just exploded to 1.1 million accounts.
Okay, but hold on. How does that actually affect OneMain Holdings, Inc., OMF's stock price for regular investors like me? Because an 8% dividend and a billion-dollar buyback sounds amazing on paper, but isn't a yield that high usually? Like a financial mirage.
What do you mean by mirage?
Like a company taking out a high-interest credit card just to pay its own shareholders a dividend. It feels like buying a mansion on the edge of a crumbling cliff.
Well, it is a totally valid suspicion. High yields very often act as dividend traps if the underlying business is borrowing to sustain the payout. But the cash flow data tells a vastly different story here.
Really? How so?
These payouts are supported by a 33% increase in capital generation, hitting $913 million for the year.
Oh, wow. Meaning they are generating significantly more cash from their operations than they actually need to cover that dividend?
Exactly. The math checks out beautifully. The dividend obligation costs them roughly $500 million annually. So with $913 million in capital generation, that dividend is remarkably well covered.
So they aren't stretching themselves thin at all.
Not at all. They have the actual cash on hand to pay the dividend, buy back the stock, and still reinvest in those massive auto and credit card expansions we just talked about.
Okay, so the cash flow is real, and the payouts are safely covered. That tells me the threat driving the stock down isn't coming from inside the house. The market must be pricing in some sort of external existential threat.
And that brings us to the elephant in the room.
Right. New York Attorney General Letitia James and this massive 13-state lawsuit.
Yeah, this is the storm cloud that has Wall Street genuinely spooked. You cannot analyze OMF without looking at the reality on the ground for their customers, and more importantly, how state regulators view those interactions.
Letitia James, alongside 12 other states, just filed a major lawsuit against OMF, right? Alleging deceptive sales practices, hidden fees, and basically forcing borrowers into what they call useless insurance products.
Yes.
Let's break down that useless insurance claim because it sounds kind of vague until you look at the mechanics. What exactly are they selling these customers?
So primarily they are talking about credit life and credit disability insurance. The pitch to the borrower is basically if you die or get injured and can't work, this insurance pays off your loan.
Which, I mean, sounds helpful on the surface. Why do regulators hate it so much?
Because of how it is financed. Regulators allege that OMF adds the cost of this insurance premium directly into the principal of the loan.
Oh, I see.
Right, so the borrower isn't just paying for insurance. They are paying 17% to 25% interest on the insurance premium for the entire life of the loan.
Ouch. Yeah, that changes things.
Furthermore, regulators claim borrowers are often rushed through the paperwork and don't even realize this optional product has been baked into their monthly payment.
Well, that explains the market's swift reaction. The stock dropped between 8% and 12% immediately on the news. I mean, Wall Street analysts just hate regulatory uncertainty.
They despise it. Evercore ISI actually downgraded their price target from $69 down to $55.
That's a huge drop.
Yeah, and they specifically cited this lawsuit as a near-term overhang that institutional investors just do not want to navigate right now.
And honestly, if you look past the institutional analysts and listen to actual borrowers, you see exactly where the friction originates. The lived experience of an OMF customer is incredibly complex.
It really is. Did you look at any of the borrower forums?
Yeah, we actually dug into some of the sentiment on Reddit, specifically their more debt-free community, just to see what Main Street is saying. Real borrowers are actively complaining about 17.3% interest rates. But the biggest point of anger, by far, is how OMF handles the interest. Borrowers claim the interest is heavily front-loaded.
And this brings up a crucial lending mechanism known as pre-computed interest, or the Rule of 78.
The Rule of 78s.
Yeah. Unlike a traditional mortgage where you slowly chip away at the principal every month, some subprime loans apply almost all of the interest to the first few months of payments.
Which completely traps the borrower. Like if you take out a $10,000 loan, make payments for a year, and then get a bonus at work and try to pay the loan off early, you might find your principal balance is still sitting at like $9,500.
Exactly. You spent a whole year essentially just paying the interest.
The frustration is so palpable in those forums. There are also these really severe stories about aggressive collateral seizing because these are often secured loans, right? Meaning OMF has the right to the underlying asset.
Yes, they do.
Like this one Reddit user whose car caught on fire. The insurance company issued a payout check, but because OMF held the lien on the car, OMF intercepted the entire check to pay off the secured loan.
Leaving the borrower with no car and no cash to buy a replacement.
Exactly. It just highlights the harsh reality of secured subprime lending. The lender protects its capital fiercely, but, to maintain an objective view of the source material, the sentiment isn't entirely one-sided.
No, it isn't.
In those exact same Reddit threads, you have users fiercely defending OMF.
I saw that too. People pointing out that when they lost their jobs, or had a pipe burst in their house, or faced a massive medical emergency, traditional banks wouldn't even return their phone calls.
Right, the algorithm just auto-rejected them.
Exactly.
Oh.
OMF was literally the only institution willing to extend credit when they were absolutely desperate.
It perfectly represents the classic subprime dilemma. They are providing an essential lifeline to a demographic locked out of the financial system, but that lifeline is incredibly expensive.
And we really have to place this tension within the broader macroeconomic context, too. Over the last few years, we've seen a persistent inflationary environment that has uniquely attacked this specific demographic.
Because inflation doesn't hit everyone equally. If you are a high-income earner, an extra $100 a month at the grocery store is, well, it's annoying. But if you are a low to moderate income family, that extra $100 wipes out your entire monthly financial buffer.
Right. Groceries and rent are highly inelastic. You have to pay them to survive. So when those prices surge, the disposable income meant for servicing debt just vanishes. Combine that with a slight softening in the labor market, and you have a demographic under immense pressure.
Right, I get all that, but what does all that actually mean for OneMain Holdings, Inc., OMF investors right now? Wall Street knows inflation is high. How are they pricing in this regulatory and macroeconomic storm?
Well, Mihir Bhatia, an analyst over at Bank of America, analyzed this exact intersection of legal and macro risks. His insight is that this 13-state lawsuit is primarily a headline risk.
Just a headline risk.
Yeah. BofA actually maintained their buy rating on the stock. They did lower their price target slightly, from $74 to $66 to account for the uncertainty, but their core thesis remains completely intact.
So they don't think it'll ruin the company?
Not at all. They believe that while the legal fines might sting in the short term, the lawsuit is highly unlikely to fundamentally destroy OMF's core business model.
Okay, so compared to last quarter, what actually moved the needle here? Because we know the customers are under pressure from inflation and we know the states are suing, we need to look under the hood to see if the actual loan portfolio is cracking right now. Are people still paying their loans?
The quarter-over-quarter metrics do reveal some expected deterioration. We need to look at net charge-offs, or NCOs.
NCOs, okay.
This is the percentage of debt that the company officially writes off as unlikely to ever be collected. That metric rose from 6.67% in the third quarter to 7.56% in the fourth quarter.
Wait, 7.56%. So basically, it's kind of like a bakery expecting a certain number of loaves of bread to go stale on the shelf every day.
Yeah, that's a good way to look at it.
Like 7.56% of your loans going bad sounds utterly terrifying to a regular person. But if they price the bread high enough in the first place, they still make a profit.
That analogy captures the mechanism perfectly. A 7.56% default rate would instantly bankrupt a traditional prime bank offering 6% interest rates. But OMF prices their loans at those 17% to 25% APRs specifically to absorb that elevated level of staleness.
I see.
The crucial takeaway is that despite the NCO rate rising to 7.56%, total revenue still grew 8% year over year, hitting $1.6 billion in the fourth quarter.
And the 30-plus day delinquency rate, which measures people who haven't defaulted yet but are just late on their payments, remained impressively steady at 5.65%. The company claims this is exactly within their expected guardrails.
Management was completely unfazed by the fourth quarter jump in charge-offs. They attributed it to two entirely predictable factors.
Which are?
First, standard seasonality. The holidays always strain consumer wallets, leading to missed payments in December and January. Second, they're mixing in more of those new credit card accounts we talked about earlier.
Ah, right, because an unsecured credit card inherently carries a higher default rate than a structured personal loan.
Precisely. The math reflects that structural shift. Looking ahead, their 2026 guidance projects NCOs stabilizing between 7.4% and 7.9%. They are actively modeling for these elevated losses.
Which brings us to the ultimate question. If 7.5% to 7.9% of their loans are guaranteed to go bad, and they have the state of New York actively trying to cap their fees and alter their sales practices, how does OMF plan to survive without imploding?
By relying on a highly defensive, almost pessimistic corporate strategy. At the recent Bank of America conference, CEO Doug Shulman pulled back the curtain on their underwriting mechanics.
And what did he say?
Well, they do not just blindly approve loans to hit growth targets. They require a strict 20% return on equity, or ROE, for every single loan they originate.
And to guarantee that 20% return, they do something fascinating, don't they? Shulman revealed that since 2022, they have been applying a massive 30% stress overlay to their internal loss estimates.
They have. Let's break down how that actually functions. If OMF's algorithm looks at a borrower's profile and predicts a 5% chance of default, the underwriting team artificially inflates that risk.
So they make it look worse than it is.
Exactly. They treat it as if there is a 6.5% chance of default. They are actively making their own underwriting test harder to pass.
It's like training for a marathon while wearing a weighted vest. They are underwriting every single loan as if a mild recession is already happening today.
That level of discipline is really rare in the subprime space. And they pair that underwriting rigor with a fortress balance sheet. They are currently sitting on over $7 billion in bank lines and have built a full 2 years of liquidity runway.
2 years?
Yes. If the capital markets froze completely tomorrow morning, OMF could fund their daily operations for 24 straight months without needing to borrow another dime.
That's incredible. They even secured the industry's first AAA-rated blockchain asset-backed security. Wait, explain that to me. How does using blockchain suddenly get a subprime lender a pristine AAA rating from S&P?
It comes down to structural transparency. Traditional mortgage-backed or asset-backed securities are often, well, a black box.
Right.
The rating agencies just have to trust the bank's internal spreadsheets about how the underlying loans are performing. But by moving the asset-backed security onto a blockchain, OMF created an immutable, real-time public ledger.
Oh, I get it. S&P doesn't have to trust OMS word. They can cryptographically verify every single loan payment exactly as it happens.
Yes, that absolute real-time transparency is how a subprime lender achieves a prime AAA rating.
That is brilliant. So basically, it's like they are driving a tank through a financial minefield. They fully expect some loans to blow up underneath them, but they've intentionally built the armor so thick with 2 years of cash, strict underwriting overlays, and transparent blockchain ledgers that they can just keep rolling forward.
The tank analogy is highly accurate, and you know what the literal tracks of that tank are? Their physical branch network. OMF isn't just an app on your phone. They operate 1,300 physical branches across the country. That is a larger physical footprint than many mid-sized regional banks.
Why does that matter, though? I mean, in an era where everyone does their banking on their smartphone, why spend the overhead to keep 1,300 strip mall branches open?
Because of the psychology of the subprime borrower. When you are financially vulnerable, dealing with sterile fintech apps is terrifying. An app just sends you an automated push notification when your payment is late.
Yeah, that's true.
But a local branch manager looks you in the eye. They understand that the local manufacturing plant just cut overtime hours, which is why you are struggling this month.
The human element builds fierce loyalty, and the stats on those branches really back that up. The average branch manager has 14 years of tenure.
14 years. That's a long time in this industry.
And crucially, they aren't just paid commissions to push loans out the door. They are compensated on both loan production and delinquency.
That incentive structure changes everything. If a branch manager writes a bad loan just to hit a monthly sales target, and that borrower defaults 6 months later, it directly hurts the manager's own paycheck.
Wow.
They are financially incentivized to only write loans that they believe people can actually pay back.
Which creates this incredible 30-year data moat. A shiny new Silicon Valley fintech startup cannot easily replicate the deep community trust of a 14-year veteran branch manager, nor can they replicate 3 decades of non-prime consumer data stretching across multiple economic cycles.
No, they can't. And when you pull all these threads together, you are left with 2 entirely distinct faces of OMF. On one side, you are looking at a highly disciplined, cash-generating machine, a financial tank wrapped in a fortress balance sheet, tossing off a massive dividend and buying back $1 billion of its own stock.
But on the other side, you have a massive regulatory target serving a deeply vulnerable demographic. A company facing a 13-state lawsuit led by the New York Attorney General, relying on 17% to 25% interest loans that financially exhaust the very consumers they claim to be keeping afloat.
It really is the ultimate paradox. The sun is shining brilliantly on the balance sheet, but there is a brutal legal thunderstorm pouring down just outside the window.
The data aggressively prints in both directions. Your view on the stock entirely depends on how much weight you assign to the headline legal risk versus the undeniable underlying cash flow.
Exactly.
Before we wrap up, consider this provocative thought for you, the listener. As traditional regional banks continue to take massive losses on commercial real estate, they are aggressively tightening their lending standards. As prime banks retreat, non-prime lenders like OneMain Holdings, Inc., OMF, might slowly become the only available credit avenue for the broader middle class.
That's a huge shift. We might not just be looking at a niche subprime lender. We might be looking at the future of mainstream American credit.
We really might. And look, we are not going to sit here and give you a definitive verdict on whether the stock is a screaming buy or a radioactive sell. We laid out the paradox, but it's up to you to decide what the temperature really is. All right, listeners, what's your take on the future of OneMain Holdings, Inc., OMF? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Byte-Size Brief.